Let's talk money.
Welcome back. You are watching the post-budget special edition of Let's Talk Money. It's the capital gains classroom where we're trying to go over all the changes and understand what that means for our portfolios. Still in conversation with Mohit as well as Srivatsan Chari. Now let's talk gold, folks, because that also is an important asset class for a lot of people out there. And Srivatsan, I want to start with you with the basic changes because first gold was, getting 20% taxation, but with indexation benefits if you held physical gold for 3 years. Now, I guess that, that time period has come down to 2 years, but no indexation benefit, right? Just go over the changes when it comes to physical gold.
Cool. I think the indexation being cut, the immediate impact was the import duty on gold has been reduced from 15% to 6%. And since India is like a huge importer of gold, this caused the gold rates to fall. And a lot of the hue and cry that you saw around SGBs was, I think, a huge expectation mismatch from an investor perspective. So now it fundamentally translates to, for people who absolutely want to buy gold, let's say for jewelry or something, it's a good time to buy. But if you're already invested in gold and you're now going to see a drop that is obviously going to be frustrating. This will be, a little bit temporary maybe. Now, forward looking, if you're looking to play the market and you're thinking between SGBs and other classes like ETFs, the decision fundamentally comes down to your willingness to hold and the sort of liquidity that you desire. That's our take on it.
Okay, let's just take that point forward. So, Mohit, we'll come to the gold funds and ETFs in just a bit. But up until now, I remember all the shows that we've also done together, sovereign gold bonds were spoken as the best instrument, financial instrument through which you can invest in gold. But now investing in physical gold itself is becoming so enticing, right? With the customs duty cut and this capital gains tax cut. So now what do you say?
So look, I think I would still say sovereign gold bond funds will remain the darlings for gold investors. Honestly, because after 8 years, the maturity is still completely tax-free. Even if you're investing in physical gold, after 2 years, you get long-term taxation, which is 12.5, but you still have to pay that 12.5 tax. Plus, SGBs give you 2.5% interest every year just for holding it, right? The only drawback in SGB, Surabhi, is that the maturity is on a point of date, right? You can't control maturity, you can't redeem.
And you have to wait for the next tranche to come every time.
You have to wait for the next tranche to roll over your holdings out there. So I think that's a little bit of a mismatch out there. But my sense is, in terms of attractiveness, SGBs continue to remain the best form of investing in gold.
But let's also go over what happens if you don't hold that bond, the sovereign gold bond, till maturity. If you hold it till maturity, 8 full years, there is no capital gains tax. But Srivatsan, what if someone is selling, and you can, like after 5 years, the lock-in ends and you can actually sell prematurely, then how will the capital gains tax be applied?
If you're selling it early, you may not get like the fair value. And otherwise, it's taxed at the same rate as an equity itself. 12.5% if long-term, 20% if held for a shorter period.
Taxation. So you just have to pay that flat rate of tax, 12.5%. Got it. So that's sovereign gold bonds. Experts clearly saying that they still have merit because of that added kicker, the interest that you get every year on that bond. But I guess it is actually the other category, gold funds, ETFs or gold mutual funds. That's where a big change is happening for the better, Mohit.
Absolutely.
Because now, just explain how this is going to work for gold funds now.
So look, what was happening was all your gold funds, gold ETFs, even fund of funds, international funds also, you might just want to club it all together. Basically, they were all getting classified as debt because they were not holding greater than 65% in Indian listed equities. So they were all getting classified as debt funds, right? Now, because of that classification, they were getting taxed at slab rates. Irrespective of your holding period, last year the budget changed it. Irrespective
and there
of
was
your
no
holding
indexation,
period,
nothing, just slab rate taxation.
Marginal rate of taxation at your own slab rate, right? So they were actually all these classes of mutual funds became extremely unattractive, and I think saw a huge exodus plus no new inflows if you see last 1 year of data. But now they are back in reckoning with a full bang. Your international funds, your gold funds, they will all be taxed at 12.5% after 24 months, which is long-term capital gains, and that makes it extremely attractive.
You know, I just want to quickly go over the example that's flashing on the screen right now for viewers as well. We'll explain to you what that table means. Let's get that back up. What we've done is just taken an assumption Mohit helped us with basic calculations. If you're investing in a gold fund, and let's say you're doing an SIP, 50,000 or rather 5,000 rupees a month SIP running for 40 months. The reason we've taken 40 is in the old regime, you had to hold for 36 months to get the LTCG advantage. So just for an apple-to-apple comparison. So what is happening now? Your total investment is 2 lakh rupees because you've let this SIP run for a long, long time. And looking at the appreciation in gold price, roughly speaking, the appreciated price is about 2.5 lakh rupees. So now the gain is the same, but because the tax rate is coming down, the marginal rate of tax at 30% versus now 12.5%, there's a huge benefit in terms of the tax outgo. The tax outgo in this example comes down to about 6,000 rupees odd versus almost 11,000 earlier. So that's where the big kicker comes in for gold funds and ETFs. So make sure you do those calculations when you're deciding how to invest in gold. Mohit, that brings me to the final question, which is on overall hybrid funds. There's this in-between category where equity is between either 35% or 65%,
Yes.
that in between.
Yes.
What happens to them?
So that was a tricky category always, right? It was born last year, it has died this year.
Even before we could understand it and later start investing in it.
So equity between 35% and 65%, they were eligible for indexation after 3 years of holding, which is after 36 months. Now everything is gone. 24 months, 12.5%. That's the taxation which is applicable. There are certain caveats as to if you have bought it prior to 1st April 2023, which is prior to the last year's budget. Then if you go ahead and sell it, depending on the time when you are selling it, there are still certain tweaks and changes, which I would perhaps recommend every investor to do their homework and do it. But if you're buying afresh, life is very simple for you. 12.5%, 24 months holding. It becomes extremely simple.
I think we need another classroom, a separate dedicated classroom on hybrid funds, this in-between category of 35% to 65% equity. Yeah. What happens if you bought last year? Because remember, the tax regime has changed 2 years on trot for these funds, and they include a lot of popular categories like balanced advantage, multi-asset, a lot of such categories. So, Mohit, on television, I'm telling you, you've got to come back next week because this requires, I think, some more...
Absolutely. It's very complicated, depending on when you're selling it and when you have bought it. So, we should.
Super. So, part 2 of the show coming up. But before that, let me take some final thoughts with our guests. So, Srivatsan, what's the advice? I mean, this is the massive change. People will still take time to understand it. What should investors be doing? Because we look at our portfolios and tax, whether we like it or not, is a huge part of the decision-making process.
I think 2 thoughts. Stay invested for the long term. Don't use tax to make short-term choices at all. That's really what I would leave people with.
Look at that. And he's a tax expert, yet he's saying the same thing that planners say, right? Mohit, I'm sure you'll agree.
Yeah, absolutely. 2 thoughts from my side also. One, I think asset class has to find place in your portfolio basis the merit of return and not basis the merit of tax arbitrage. And second is, I think as investors, everyone should focus on crossing the swamp and not figuring out the crocodiles in it. So you will always have to face some crocodiles when you're trying to cross the swamp. But I think just focus on long term.
All right, gentlemen, thank you so much. That's part 1 of our capital gains tax classroom. And next week, we're going to do part 2, all your mutual fund issues with capital gains tax. All of that will be answered next week. See you again. And thanks very much. Keep those queries coming. We'll see you next Wednesday, same time, same place.